Hi, it's James Pacholek from CMG Wealth Management with a mid-year market update, year 2026. Well, so far so good. S&P 500 and the Dow Jones Industrial Average are up just over 9% at the time of this video. We saw some setbacks with the Iran war, the uncertainty of oil prices and what that might do with inflation, but we've seen that come back up. And today's video, we want to talk about main themes. We want to talk about interest rates. As you well know, we've got a new Fed chair, Kevin Warsh, what that means going forward, where's inflation at, and then the market in general. What's our outlook for the rest of 2026? Well, top of mind, as it always is, but this year it is a main driver, is earnings. It's all about earnings. It's worth noting all the videos we do, all the commentary we do, the ups and the downs of the market, it's all about what earnings are going. So when there's uncertainty in the markets, it can be uncertainty with earnings. All we have to do is look back at last year with the tariffs. Why did the market react so violently to that? It was something that the market couldn't get their head around. What are earnings going to do? Once we looked at what was going on and the tariffs and the calculations were done, the market smoothed out pretty quick. Obviously, you had a lot of changes with the administration and its approach to those things. But by and large, just remember, it's all about earnings. The S&P 500, the market in general, is always looking out 9 to 12 months ahead. So any uncertainty comes, that's what you will see in the market. How many times have we seen, or maybe you've seen, where a stock you were following came out with earnings and they beat on the top and the bottom line? So they had the revenue top line and the bottom line profit were good, and then all of a sudden the market just tanked. It's all about the outlook. When that usually happens, the outlook, again, it's uncertainty of earnings. How many times have we seen a stock that was doing well come out with an earnings surprise to the upside, and you see the stock just skyrocket? It goes back to those earnings not being factored into the current price. So again, without being too redundant, when we look at earnings, they look good. Couple projections. So this year, 2026, most of the analysts out there projected the S&P 500's earnings to be up about 15%. Now there's some investment shops out there that we have spoken to that said it's more like closer to 20%. Small companies, look at the small company indexes out there. What a major surprise. Year to date, up double the S&P. Why? Well, a few years ago, small cap companies had negative earnings. Last December, we saw single digit earnings revisions going up. Things were getting better. This year, they're projected to be up 30%. Big part of that's the big beautiful bill, what it does with taxes and small businesses, but 30% earnings is why that sector's up 20%. Earnings look good for the rest of the year, barring some catastrophic event that we haven't thought, it hasn't come to fruition yet. The market looks like it's on path for some more returns. Now, we have the mid-cycle coming in, midterms coming in November. There can be some uncertainty there, but by and large, remember that the market is bigger than any political affiliation out there, and it's a robust economy. I believe with the new Fed chair that's going to be, I believe, accommodative. You've got the AI move, which we are going to be sending out a few more educational videos on AI. That's just how big that sector is. We're seeing a lot of the market being driven by companies ramping up for the artificial intelligence that's to come. One thing worth noting, the semiconductors, which is memory, so not the very expensive chips like NVIDIA produces for AI, but just memory to run things. It has had an unprecedented run. If you look at companies like Micron or Texas Instruments, if you look at the semiconductor ETF year to date, it's up 88%. In fact, about 40% of the return, it's maybe just a little bit higher than that, of the S&P is in that one sector. And what it when we look at semiconductors, let's just say, for example, Micron, they're at full capacity. So everything they can produce for the rest of this year and well into most of next year has already been accounted for. So they're topped out, and that stock is up dramatically. It's gone from 100 to 200 to 300, all the way up to 1,000, then 1,200, and it's pretty volatile. But it's a real deal. It shows you that AI spend is here to stay. How that affects productivity and the rest of the market going forward, we are watching closely. At some point, you do have to monetize things, meaning if you do all these build outs and you've got AI out there and people have a wealth of information at their fingertips like no other time in history, it still has to make money. So if you remember last October, we had a little of an AI bubble scare. The market dropped 10%. And obviously that was just a blip when you consider how much AI has gone up this year. So going forward, if things look good, the market looks good. Just to touch on bonds real quickly. As you well know, we made a pretty big move back in 2000, 2001 when the 10-year Treasury hit 0.4. We got rid of most of our bonds, especially our ETFs, and it was a good move because the market went from, the 10-year Treasury went from 0.4 all the way up to 5%. We bought back in October of 23 and 24, and those positions have done well. But by and large, this year, some of the returns in accounts or the limited returns is on that bond side. The aggregate bond index is up less than 2% year to date. But here's the main story behind that. Where are rates going? Do we see hyperinflation coming back and the 10-year Treasury going to 5.5 and 6.5? If it heads that way, we will reevaluate. But right now, we've seen the 10-year be in a range in that upper threes to mid fours. It's hovered there. The likelihood is greater. The probability is greater that something happens in the market, or there's a flight to quality, or geopolitical risk, or just inflation staying in check, or even going down because of AI, that interest rates could fall. If the 10-year goes from 4.5, say, to 3.5, those bond holdings would not only yield their roughly 4%, but with their duration could be up another, say, 6%. So a double-digit return for safe money is a good place to be. And that's where we are right now. The bond market kind of lackluster, but it serves its purpose, to be 100% stock, unless that is your goal in mind. And some clients are that way. But for people who are in retirement and somewhat of a preservation or income mode, you need to have those bonds in that portfolio. And we are confident that things are going to keep looking good for those. So just to recap, we believe that the rest of the year looks good. You might have some more geopolitical issues going on there. It looks like things are calming down in Iran. The midterms are coming. It would bode well for oil to keep falling, and it is. Oil to come down, and it is. Prices to come down, and it is. That would be good for the midterm hopes for the Republicans. And then the bond market, too, we believe the interest rates are probably moving down. So the rest of the year looks good. We're always aware of what's going on, the market events as they unfold. We do have a protection strategy, and we'll act if we need to preserve. But right now, the sailing looks good. Everything is heading in the right direction. The trend is up. And so I hope everyone is enjoying their summer, and we will be back with more timely market updates. As always, if you ever need us, we are highly accessible here for you, and we would look forward to answering any questions you have. Until we talk again, we wish you all the best and take care.